Every single investing decision you'll ever make comes down to one question. How much risk are you willing to accept for how much return? Most beginner videos either underplay the risk or overplay it. This video breaks down what risk actually is, the math that connects it to return, and how to figure out exactly how much of each is right for you. Here's the math nobody can argue with. $10,000 sitting in a high-yield savings account for 30 years, earning around 3% a year, becomes about $24,000. That same $10,000 in the stock market, earning around 10% a year, becomes about $174,000. Same starting amount, same time period. The investor who took on stock market risk earned about 7 times more. That gap is what we call the risk premium, your reward for accepting volatility. First, what does risk actually mean? Most beginner videos lump 4 very different concepts under one word. 1. Volatility, short-term price swings. Stocks can drop 20% in a month, then recover. That's volatility, not failure. 2. Permanent loss. The risk that an investment goes to zero, like a single company going bankrupt. 3. Inflation risk, the silent killer. If your money earns 3%, but inflation runs at 4%, you're losing purchasing power every year. Most people don't think of cash as risky, but it absolutely is. 4. Sequence risk, the risk that you need to sell at exactly the wrong moment. A retiree forced to withdraw during a 40% crash gets hit far worse than someone who can wait it out. These 4 risks behave very differently. Smart investing isn't about avoiding risk, it's about choosing which risks to take and when. Here's the math at the heart of investing. Over the last 100 years, US stocks have returned about 5 to 7% more per year than US bonds. That gap is called the equity risk premium. It is your reward, your compensation, for accepting the volatility that comes with owning stocks. If stocks didn't pay this premium, nobody would buy them. They'd just hold bonds. So the premium has to exist for the market to function. The exact size shifts year to year, but historically it's stable. Higher risk doesn't just sometimes pay better. Over long enough time frames, it has to. Here's how different asset classes have actually performed historically. Cash in a high-yield savings account averages around 3% per year, basically just keeping up with inflation. Bonds, about 5%. Real estate, around 6%. Stocks, about 10% over long periods. Crypto, while extremely volatile, has averaged around 20% over its short existence, though with 80% crashes along the way. Notice the pattern. Higher returns come with higher volatility. The crypto chart bounces around far more than the cash chart. There is no asset that gives you 10% returns with cash-like stability. If someone offers it to you, they're either lying or scamming you. So how do these trade-offs play out side by side? On returns, high-risk investing offers 10 to 20% annual returns. Low-risk offers 2 to 5. On volatility, low-risk wins easily. Stocks can drop 50% in a year. Bonds usually move just a few percent. On time horizon, high-risk needs at least 10 years to smooth out the volatility. Low-risk works for shorter goals. On stress level, low-risk wins again. Watching your portfolio drop 30% and not panic is a learned skill. And on best use case, high risk is for building long-term wealth. Low risk is for preserving capital you'll need soon. The verdict: there's no universal right answer. The right risk level depends on your timeline. Here's a distinction most beginner videos completely miss. And it can save you years of mistakes. Risk tolerance and risk capacity are different things. Risk tolerance is how much volatility you can emotionally handle. If watching your portfolio drop 30% makes you panic sell, your tolerance is low. Risk capacity is how much volatility your finances can actually absorb. If you have a stable job, an emergency fund, and 20 years until retirement, your capacity is high, even if you'd rather not feel the swings. The right level of risk for you is the lower of these two numbers. If your capacity is high but your tolerance is low, you should still take less risk, because you'll abandon the plan during a crash. If your tolerance is high but your capacity is low, you should still take less risk, because one bad event could ruin you. The biggest mistake beginners make is confusing the two. So how do you actually find your right risk level? 4 checks. 1. Time horizon. Money you won't need for 10 or more years can take significant risk. Money you need next year cannot. 2. Income stability. If your job is stable and your expenses are predictable, your capacity for risk is higher because you can wait out crashes. If your income is uncertain, you need more cushion. 3. Emergency fund. Before you take any investment risk, you should have 3 to 6 months of expenses in a high-yield savings account. This is non-negotiable. It's what lets you avoid forced selling during a crash. 4. The sleep test. The simplest one. Imagine your portfolio dropped 30% overnight. Could you sleep that night? Could you sleep that week? If yes, you can probably handle stock-heavy investing. If no, you need more bonds or cash in your mix. 3 myths to bust before you go. Myth 1. Risk is bad and you should minimize it. Wrong. Risk is the source of return. The expected returns on stocks exist because of the risk you take. Eliminating all risk eliminates all return. Myth 2. Stocks are always risky. Only over short time frames. Over 20-year periods, the S&P 500 has never lost money. Cash, by contrast, has lost purchasing power in every 20-year period due to inflation. Long-term, cash is riskier than stocks. Myth 3. Avoiding risk is being safe. This is the most dangerous one. If you keep your retirement money in a checking account at 0% for 30 years, while inflation runs at 3%, you've lost more than half your purchasing power. That's not safe. That's just a different kind of failure. Risk and return aren't enemies, they are partners. Higher returns require higher risk. Lower risk means lower returns. The smart move isn't to avoid one or chase the other. It's to match the level of risk to your timeline, your finances, and your ability to actually stick with the plan when markets get scary.